All right. So, hello everyone. Welcome to the day two of the Masterful June webinar series for the FM paper by being ACCA. We had met yesterday wherein, greetings from Malaysia. That's great. This is what I love about the qualification. We have so many people joining in from different countries. So, it's always good to remain connected with the rest of the world. Okay, so we had met yesterday, and this is the agenda that we had covered. So, yesterday was day one that we had met, and we had covered the basics about the FM paper, the structure, the format, what are the different sections in our paper, the syllabus areas. Then we revised our working capital as well as business valuation, and then we also practiced some of the past paper questions together. So, now today we will move forward with day two. We are meeting today for day two, wherein we will revise another two key concepts from our syllabus, one of them being the cost of capital concept and another one being the risk management concept. So these two we will revise, and again we are going to practice past paper questions which have appeared previously in the papers. Are we ready? All set to get started? Shall we get started, guys? Okay, great. So right now, the very first thing that we will do is we will get started with our revision for the cost of capital area of my syllabus. Now, we know that as a company, as a business, a company has so many different options when it comes to getting their capital. A company can go for ordinary equity shares, a company can go for preference shares, they can go for bank loans, they can go for loan notes, debentures, they're all one and the same thing. So these are the different options that the companies have. Now, what do you people say? Will the cost of all of these sources be the same? Will a bank loan have the same amount of interest which I have to pay as return to my shareholders? No. All of these sources come at different costs. So in this particular unit of my syllabus, I have been taught how to calculate the cost of these different sources of finance the company can use to, we can use these formulae to find out how much does it cost to the company. So you can see I have compiled a key list of the formulae for you people. So different methods that we can possibly use, and what are the formulae for the same. So for equity, firstly, we learned about the dividend valuation model. If, for example, you have a constant dividend, a company pays the same amount of dividend every year, then the formula is very simple: dividend divided by the market price of the shares. Then sometimes it will also be the case that the dividends of the company are going to grow every year. So here the growth that you have to calculate, either the growth rate can be given to you in the question, but if it is not given to you, then there are two possible ways to calculate the growth rate also. So you could either use the Gordon's growth model. What's the formula that we've learned under the Gordon's growth model? What's the formula that we've learned under the Gordon's growth model? Yes, it's B, that is your retention ratio, multiplied by the RE, that is the return that the company is generating on the net assets. Absolutely right, guys. Then we can also use extrapolation. So what sort of data do I need to calculate my growth rate using extrapolation? What data do I need for extrapolation calculations? Yes, the information on the dividends that the company has been paying in the past. Old dividend, new dividend. Absolutely right, guys. So this is the formula that we have learned, that P0 is equals to D1 divided by RE minus G. So you can transpose the formula to find out the cost of the equity. These formulae, they are also given to you people in your formula sheet. Although by practicing so many questions over this large period of time, you people get to, memorize this formula pretty very easily. Now, we also have the option to calculate the cost of equity using the CAPM formula. We'll take care of the risk and return relationship over here. Again, this formula is also something that you will find in your formula sheet that will be given to you on the day of your exam. So you simply take the risk-free rate, you add to it the excess that the market is giving you over the risk-free rate, and then you multiply it with the beta of the company. What does beta measure, guys? What does beta of a company tells you? Absolutely. Beta measures risk of the company. How do we get to know if a company is risky or less risky? What are the ranges in which the value of beta can possibly go? Yes, we take one as the market risk. So if my beta is more than one, then we say that the company is more risky or less risky than the market. More risky than the market. And if my beta is less than one, then it is lesser risky than the market. So these were the concepts that we studied about beta also. Then, guys, another source of finance that the companies have the option of using is the preference shares. Again, we use the dividend valuation model for this. So here it's very simple. Whatever is the dividend that we are paying over the preference shares, you divide that with the price of the preference shares. So the market value that we have, we divide the dividend with that value. So that tells you how much is the worth of the preference shares. Then when it comes to irredeemable loan notes, redeemable loan notes, and the convertible loan notes, no, we for the redeemable loan notes, we have a different formula. Guys, what's the formula that we use for the redeemable loan notes? What's the formula that we use for the redeemable loan notes, guys? For the redeemable and the convertible loan notes, we take the IRR of the cash flows. But for the the irredeemable loan notes that we have, guys, we use the pretty much same formula that we have for the preference shares. I think I made a mistake over here. For the irredeemable loan notes, it's not the IRR, it's actually the interest divided by the P0. I think it got mixed up from here. This is what should be written over here. The interest that we are paying as the company divided by the P0. And then for your redeemable loan notes and the convertible loan notes, we find out the IRR of the cash flows. And which sort of cash flows do we consider while we are calculating the cost for the company? Is it the pre-tax cash flows or the post-tax cash flows? Always the post-tax cash flows. Why? Because when we are calculating the cost, we are looking at the perspective of the company. The company gets tax benefits, so we do our workings taking into account those tax benefits. But then, guys, when we are working on the valuations, when we are working around the valuation, how much should be the market value of a redeemable loan note? Then we find out the NPV of all of the cash flows. Do we take those cash flows as pre-tax or post-tax? In valuation, we consider pre-tax cash flows. Those of you who are saying post-tax, you're wrong. Pre-tax cash flows are considered. What is the reason behind that? Because while you are doing valuation, whose perspective are you guys looking at? Whose perspective? We are looking from the perspective of investors. Do the investors get any tax benefit because of investing in debt? No. So we do not consider any tax workings. Tax workings are only considered from the perspective of the company. Yeah, sure. I'm repeating why, we are using these pre-tax and post-tax depending upon the perspective. There are two areas where we use similar formulae. One is where I'm calculating the cost. One is where I'm calculating the market value. So when I'm calculating the cost, who pays the cost? The company pays the cost for using the source of finance. So whenever I'm calculating the cost, I'm looking at the company's perspective. I'm seeing it from the company's perspective. So as a company, for example, I'm paying $10 as interest, but in the country where I'm operating, I'm also paying 30% taxes. Now, because of those $10 of interest that I'm paying, my taxable profits will go down by $10. So I get a tax benefit. That is why whenever companies look at their cost, they will consider how much is it costing them in the net effect. So they paid something to the investors, but they also ended up saving something in the form of taxes. So whenever the company is calculating their cost, they will always consider what it has costed them after adjusting the benefit that they got from the taxation perspective. That is why always and always the post-tax cash flows are considered. Then when it comes to the IRR. On the other hand, when we are doing the valuation, it's done, the market value. It is something which happens in the market. So the company is not buying and selling these loan notes. The investors are buying and selling these loan notes. So whenever I am calculating the market value. Market value is always from the perspective of the investors. So when investors are having a look at it, if Shreya, you are investing your money in a particular loan note, just because your loan, you have invested your money over here, the company is getting tax benefits. You are not getting any tax benefits. So to you as an investor, tax benefits have no relevance. So you take the cash flows on the face of it. You do not have to convert them into the post-tax cash flows. You consider them before any taxation adjustments. I hope that this is clear to everybody. This is a very common key conceptual mistake which the FM students make, especially if you guys are self-studying or you could not probably understand it wherever you studied. So this is a very important concept. Is everybody with me on this? Yes, do you all follow? Okay. Now, guys, we move forward to bank loans. For bank loans, it's pretty simple. Whatever rate is given to you in the question, it's usually the pre-tax cost of using the bank loan. And if you want to go for the post-tax rate, you simply multiply it with 1 minus the tax rate. So this is the way that you can convert the pre-tax rate into the post-tax rate. So these are all the formulae at a glance that we have learned for different sources. Are you all with me till here? Shall we head forward? Okay, guys. Next, we are going to talk about the WAC, the weighted average cost of capital. Now, as a company, you're using so many different sources of capital. If, for example, a company has $100, it's not necessary that all 100 will come from only one source of finance. Out of 100, maybe 50 comes from equity, the ordinary shareholders that I have. Then, for example, 30% comes from the preference shares that I have. And then let's suppose the remaining 20% comes from maybe the loan notes which the company has issued. So many different sources of finance that the company is using, and the costs are also very, very different. Cost of equity will be different from the cost of preference shares, from the cost of loan notes. So as a company, how do you get to know that exactly how much of return is needed by the company to at least pay for the costs on time, paying the interest on the loan notes, paying the preference dividend to the preference shareholders, and ultimately also compensating the shareholders for the risk that they are taking at the company. So for that reason, what do we calculate is called as the weighted average cost of capital, with the help of which we combine the cost of all sources in one number, and then we weigh it usually by the market value of my equity, preference shares, and the loan notes. There's another method to do it via the book value, but within, if you people are given the choice going for the market value or the book value, which one do you think is more preferable? Which value are more preferable, market or book? Market value is always more preferable. And what's the reason behind that, guys? What's the reason that market values are preferable over your book values? Book values may be outdated. There can be massaging done to the book values. The numbers can be manipulated, but the market value will be more updated. It will reflect the current situations in a much better manner. That is why the market values are considered to be more relevant. Then, guys, just to have a quick recap of what are the steps that we should be using when it comes to doing our WACC calculation, you can see that there are 4 primary steps. First step is I have to find out the cost of each source individually. So whatever different sources the company is using, equity shares, preference shares, debentures, loan notes, bank loan, I will individually calculate the cost of these different sources that the company is using. So I will use the appropriate method. If, for example, for the cost of equity, CAPM data is given, so I will use CAPM to calculate the cost of my equity. Similarly, if the other sources are telling me, I will use the methods accordingly as we have just revised above. Then step number 2, once I have the cost of all different sources with me, step number 2 will be to calculate my weights. Weights means how much is the proportion of a particular source of finance in comparison to the total equity. So what does that mean is, for example, a company has total market value of $450 million, out of which $300 million is the value of equity and $150 million is the value of, let's suppose, the bank loan that the company has taken. So in that case, how will proportions be calculated? Equity proportion is 300 out of the total of 450. Bank loan proportion is 150 out of the total of 450. So this is how the proportions or the weights are calculated. And then what do is we multiply the cost with the weight. So for example, for the equity, the cost was 6%. For the loan notes, maybe it was 2%. So this is how I multiply and then I add the numbers together to get to my final weighted average cost of capital. Right? So this is how we perform the 4 steps that we have as part of the weighted average cost of capital calculation. Niyati says, I have a doubt that while calculating weights, we have to take the total of market value and divide with each. So we have to take what in numerator and denominator in cell Excel. So basically in your Excel files, you can type it out this way, that your numerator will be first of all 300, that is the proportion of equity. Divide this by the 450 figure of the total number, close the bracket and then multiply by 6%. So this will give you the overall cost of equity. Then you are going to add to this particular number 150 divided by 450 into 2%. So this is how you will write the brackets and everything, and then ultimately you're going to add both of these cells together to get to your final answer of the weighted average cost of capital. Are you all with me till here? WACC calculations, all 4 steps revised? Yes, let's proceed further now. So these are capital structure theories, which most of you people take either lightly, or even if you try to understand this, these are few concepts which the students are not really able to either understand properly or retain properly and apply it in the best manner in your exam. So primarily, guys, we have studied these theories as part of, the sources of finance area of our syllabus. And a lot of times, believe me, guys, questions worth 8 marks have been tested from the theories. So if you're leaving behind these theories, you are straight away depriving yourself of the 8 marks, which you could have obtained if these are the theories that you paid a little bit more attention to. And that's just a section C question that I'm talking about. Some of it may be tested in section A. Some of it may also appear in section B. So a good 10 to 12 marks of your paper could possibly be structured from these theories. So ensure that you have a very good understanding of these theories. The very first one that we start off with is the traditional theory. Now, if I ask you people, does the traditional theory have any backing when it comes to the, the theoretical backings or the foundation that it has theoretically? No, it does not have any theoretical foundation. It's not scientifically proven. Because of the same reason, we've given another name to this theory. What's the name of this theory? Another name? Traditional theory is also called as the intuitive approach. Absolutely right. No, Chitransh, M&M is a completely different theory altogether. This is exactly what I am telling you people. You are not clear with these concepts. They come up in your exams and then you end up losing these marks. So please ensure you people are not losing out on these marks. You study all concepts very, very properly, particularly this concept if this is weaker for you. So this is also called as the intuitive approach because there's no theoretical backing, no theoretical foundation for this theory. Now, if I talk about what this theory says, this theory has certain assumptions. What are the assumptions as per this theory? So we're basically, as part of capital structure, firstly understand what exactly do we mean by capital structure. Capital structure means if the company in total has $100 worth of capital, how much of it will come from debt? How much of the $100 will come from equity? So if, for example, 70% comes from equity, 30% comes from debt, then this is the capital structure of the company. We call it as a 70-30 structure. This is what we mean by capital structure. Now, these theories, they tell you that if a company starts to take more and more of debt, what will happen to the cost of capital? So firstly, the traditional theory tells you that if you have a look at your cost of equity is what we pay to the equity shareholders. So equity shareholders, initially when you have a low gearing level, your cost of equity will start to rise slowly as you begin to take more and more of debt. Now, at this particular point in time, you are getting debt for cheaper. If you just compare, guys, between cost of equity and cost of debt, which source is more expensive? Equity or debt? Which is more expensive? Equity is more expensive usually. And can you people tell me the reason why equity is more expensive than debt? Yes, equity shareholders take a higher risk compared to the debt holders. Absolutely right, guys. So if they're taking higher risk, then they will want to be compensated with higher return also. So that is why cost of equity usually will be higher than the cost of debt. So now what happens is, as a company starts to take debt slowly and slowly, the cost of equity rises slowly because right now the risk is not very much. As the risk is starting to increase, the cost of equity is increasing slowly. And you, as a company, you are getting a benefit. Why? Because your cost of equity is increasing, but it's only a small increase. On the other hand, you're getting a very good benefit because the debt is very, very cheaper compared to equity. This is what is happening so far. Now, what happens is, as company further keeps on taking more and more of debt, as I reach higher levels of gearing, what happens is my company now becomes more financially risky. Why? As I'm taking more and more debt, imagine that the company is not doing very well for, let's suppose, 1 year. Now, can I go to my people who have given me a loan? Can I go and tell them that this year I will not pay interest because my business has not made profits? Is it possible? Can I do that? Can I tell the bank I'll not pay interest because I did not make profits? No, I have to pay interest irrespective of whether I make profits or I make losses. So what happens is, as the company starts to take more and more of gearing, the financial risk increases. And what happens is, the financial risk increase actually outweighs the benefit that we were getting. What was the benefit that we were getting? Cheaper debt. But now, because of the financial gearing that's increasing, the financial risk is increasing. As a result, the equity cost also starts to rise rapidly. And then at very high levels of gearing, guys, even the cost of debt starts to rise, because somebody who is giving you a loan also, now you already have so much of debt. So if you're taking more debt, then even for a debt lender, your company becomes very, very risky. So for debt also, they will start to charge higher rates of interest. So as per this particular theory, we come to one conclusion. Is there a level at which we can optimize the cost for the company? As per the traditional theory, is there a level at which the cost can be optimized for a company, guys? Yes, there is. But is there any formula that this theory gives me that I can use this formula? No, I cannot use any formula. What is the way that I can use this theory to come to a capital structure for my company? Trial and error is the only method. Absolutely. Yes, Twinkle, these are the assumptions of the traditional theory. What you see in bullets, these are the assumptions. And beneath conclusion, the point that you see, this is the conclusion of the traditional theory. So you people are absolutely right. Trial and error is the way that if a company wants to use this theory, they have to do hit and trial, see that at different levels of debt to equity ratio, what the cost will look like. So wherever the cost is minimum, the value of the company will be, what will be the value of the company when cost is minimum? Value of the company will be maximum. Absolutely right, guys. So this was the traditional theory. Now we move ahead with the M&M theory. So basically, these were two scientists who used to exist in real life. They were called Modigliani and Miller. So these two people, they worked together to find out what is the best capital structure for any company to use. Now, when they came up with their model, firstly, they took a lot of assumptions, and then they were criticized a lot for one particular assumption. Because of their criticism, they came up with another theory. So with M&M, you'll not just study one theory in this paper, you would have studied two theories. One is the M&M with tax theory, and one is the M&M without tax theory. So first of all, when they developed their very first theory, they had this assumption that there are no taxes in the economy. Now, you people tell me, in practically majority of the countries around the world, what do you see? Are taxes being levied by the governments or not? Taxes are being levied by the governments? Yes, the governments do charge taxes. Definitely, there used to be some exemptions. You had the exceptions of countries like UAE. Dubai used to be a place where there were no taxes. But now we even see that even the places like Dubai, they have started to introduce taxes. So it's not practically possible in a real business world that no taxes will be applicable. So these two people, they were criticized so much that they decided to come up with a new theory where they relax this assumption. They say, okay, taxes do exist in the economy. Now let's see what happens. So we will study both of the theories one by one and see what were the assumptions and what were the conclusions as per these theories. Some of the assumptions that you see are common in all of the M&M theories that we have. Just one no tax assumption gets relaxed in the M&M with tax theory that we will study as the second one. So all investors are assumed to be rational. They are all well-educated people. They know where to invest their money, how to make good returns. So they are taking good decisions in the economy. Your capital markets are assumed to be perfect. Now, you people tell me, is this assumption that the capital markets are perfect, is this assumption true in the real world? No. Capital markets in the real world, which sort of efficiency do the capital markets in the real world have? We have studied this also. No, it's not weak form efficient. Most of the markets around the world are semi-strong efficient. Absolutely. The economies that we have around the world, the stock markets that we have, the UK stock markets, NYSE, New York Stock Exchange, the stock markets that we have here in India, they are all semi-strong markets. No market is called as perfect or completely strong. And weak markets also, we don't usually see in the practical world. So capital markets are perfect. This is another assumption. Third assumption is that there are no taxes. This is only applicable for the without tax theory. In the second theory, we are relaxing this particular assumption. It will be, we will go ahead with normal that taxes are applicable in the economy. Another assumption is that investors are indifferent between personal and corporate borrowing. Indifferent means not caring. So investors in this particular, as per this assumption, it's telling me that my investors don't care whether I am borrowing on my own or the investors are borrowing. So for example, you people are investing in a company or the company is borrowing money from itself. So for your investments, you people borrow money from the bank. So you will not care whether you have to borrow from the bank versus whether a company has to borrow from the bank. What do you people think? In real life, will the bank charge the same amount of interest if you go to the bank to borrow and if the company goes to a bank to borrow money? What do you people think? Interest rates are going to be different. They will not be the same. So again, this assumption also does not really hold true in the real world. Another thing is that there is no financial distress risk. Financial distress risk means a point where, even the debt cost starts to increase because the financial distress risk is happening. So here there are no risks. The customers will not be scared that the company will shut down. Employees will not be worried that the company is making losses, so they will shut down. Nobody is worried. There is no financial distress risk, which is assumed over here in M&M theory. Another thing is that there's a single risk-free rate of borrowing in the economy. If I talk about the borrowings that we see people making today, if you just go to You don't have to go very far. In your same city, if you go to three different banks and you ask them that I want to make some investment in a fixed deposit, what do you people think? Will they all offer you the same amount of interest? All three banks will give you the same rate? No. So, finding out one single risk free rate for borrowing in an economy is an extremely impossible task to do. Another assumption that we have here is that corporate debt is irredeemable. Irredeemable means that this money will never be returned back to the investors. The debt will be perpetual. We will keep this money forever. We'll keep paying interest every year to the debt holders. And only when the company is shut down, when we are winding up the company, then the money will be returned to the debt holders. So these are the assumptions that we have as part of the M&M theories. Then let's discuss what the with tax and the without tax theories are all about. So the assumptions as per the without tax theory is your cost of equity is going to increase at a constant rate. So as the business starts to take more and more of debt, the cost of equity will start to increase because of the financial risk. The investors, the equity investors, they are going to think that the company is taking more and more debt. So we are taking more risk. That is why we want to be compensated with higher return. So my cost of equity will increase. Then my cost of debt, this is something which will remain constant at all levels of gearing, whether I'm at lower levels of gearing, whether I reach the highest levels of gearing, my cost of debt will remain exactly the same. How is that happening? Is it linked to any other assumption that we had taken? Why is KD remaining constant? Why is it not increasing? Yes, we have assumed that there is no financial distress risk. Absolutely. And then what happens as per the M&M without tax theory is that my cost of equity is rising with more gearing that the company is taking because financial risk is increasing. So my cost of equity is rising. Now, because of cost of equity rising, this is a bad thing for the company because this will push my WACC up. But what is happening is I am also taking more and more of debt, and debt which is actually cheaper debt. So whatever benefit I'm getting because of cheaper debt, that benefit is exactly equal to the extra money that now I have to pay to my equity shareholders. So in net effect, I am standing at zero. I got some benefit because of cheaper debt. For example, I saved $10,000 because of cheaper debt. On the other side, because of increasing cost of equity, I have to spend $10,000 extra exactly. So the net benefit is zero. I saved 25,000. I saved 10,000 and then I ended up spending another 10,000. So then my net effect is zero. So that means my WACC is going to remain constant. So as per the without tax theory of M&M, we have this conclusion that the WACC, is it going to be affected by the way the company decides to finance its capital? Will the WACC of the company, value of the company, be affected by the way that they are getting their money from? How much money comes from which source? No, it will not be affected. Why? Because no matter how much level of debt you take, no matter how much level of equity you take, your WACC remains absolutely constant. So what is it going to be? If I want to increase the value of my company, if I want to decrease the cost of capital for me, my investment decisions, absolutely correct, Shreya, have to be taken properly because these assumptions do not hold true in the real world. We will also study, overall, both of the theories that we have studied, the M&M without tax theory, with tax theory, their assumptions are too simplistic. They do not hold true in the real world. Now coming to the M&M with tax theory, guys, with tax theory basically says that yes, okay, tax is there in the economy. Now, if taxes exist in the economy, what will happen is on my cheaper debt, firstly, I'm getting the debt at a cheaper cost. Then I am also saving taxes because of paying the interest on the debt that I am taking. So what happens over here is as a company starts to take more and more of debt, the cost of equity rises as it was happening in the without tax theory also. This is going to reflect because of my increased financial risk, the cost of equity is rising. KD also remains exactly the same because M&M has assumed that there is no financial distress risk. then what happens over here is, because I'm taking more and more of debt, it is reducing the tax payments that I have to make as the company, because I'm getting a tax shield benefit due to the presence of interest. Now, what happens is, because of this tax benefit, the WACC of the company, the weighted average cost of capital, falls down and the value of the company increases. So, as per this particular theory, we come to a conclusion that if the company wants to maximize its value, minimize its cost of capital, what's the best solution? Take as much debt as it is possible. As high as 99% of the company can be financed on the debt, and the remaining will be via equity. So the more debt you keep on taking in your company, higher the value of the company is going to get. So these are the theories that we have covered as part of the M&M theories. Do you all follow till here? Any queries, please let me know. Yes, absolutely, Shreya. A company cannot be fully funded by debt. That is why we say that these theories are not practical in the real world. Nobody can operate like this. Can I get some responses? Do you all follow till here, everybody? Okay, great. So now we move forward. Before we go ahead with question practice, I'll give you people some tips. We had discussed these tips yesterday also about section C, just to have a quick recap. First of all, my first tip to you when it comes to section C, your first step should not be to read the case study. Your first step should be to actually read the requirements first. So before you start solving a section C question, your very first step should be to read the end requirements rather than delving deeper into the case study in the first go. Once you have read the requirements, you've understood what exactly you're supposed to calculate, what exactly you're supposed to discuss, then you start reading your case study. So when you start to read your case study, tip number 2 is that you should always highlight the key information. Now, once you have read the requirements, you know what are the different workings you're supposed to do. So any information that you see in the case study which you think you could need to come back to later for the solving purposes, you can highlight that information so that you don't waste a lot of time in locating that information again. Another thing is match the answer length to the marks that are available. This especially goes for your discussion-based answers, guys. A lot of you, you end up writing only what you know about a particular concept. But if the requirement is carrying more marks, I have to give enough depth to my answer so that I'm able to obtain the marks that are available. I have also told you people this yesterday that you should always prefer short paragraphs over long essays. Nobody wants to read the long paragraphs that you are writing, the long essays that you're writing. Summarize your points, be crisp, be precise, and use subheadings wherever it is possible. Another thing is use your spreadsheet wisely. Show all of your workings very, very clearly so that even if your final answer is wrong, examiner can still award you marks on the basis of the own figure rule. And last but not the least, time management is very, very important. We have 20 marks for a section C question. So 20 times 1.8 gives me 36 minutes that I have to be able to solve a section C question. If we do not write subheadings, is it okay? It's not recommended. It's recommended if you want to score good marks, subheadings should be there in your answers. Okay. Now, are we ready to get started with the question practice? Okay. So I am switching my screen now to practicing a question together. Can you people see my switch screen now where you will be able to see the question presented in front of you? Okay, great. Thank you for confirming. This is LaForge Company, and as you people can see, you will find this question in the Kaplan exam kit very easily. This is also a past paper question that came up in the March-July exams of 2020, of the year 2020. So what's the first thing that I should be doing over here, guys? Should I read the case study? Yes, I should be going ahead with the requirements first. So I scroll down and I see that my 20 marks are divided into 4 requirements, A, B, C, and D. The very first requirement, which carries 4 marks in total, for the rights issue, I have to calculate the TERP, the theoretical X rights share price. Let me also keep highlighting the information that is important. I'm highlighting my final requirement. I need to find out the TERP. I need to find out the value of a right per existing share. This is what I have to do for 4 marks. Then another 5 marks are available in part B, where I have to assume that the investment goes ahead. Calculate LaForge Company's forecast earning per share for the coming year and the resulting share price. If the financing is done using, for the first part, using the rights issue, second part using the loan notes. Thirdly, I have to discuss the ways in which a company can issue new equity shares. So this is a purely theoretical discussion based requirement. So you people tell me, is my answer supposed to be linked over here to the case study, or can I write a generic answer? Yes, here my answer will be generic. How can I say that it will be generic? How do I get to know that it's a generic answer that I'm supposed to write? Company name is not mentioned. Neither do we see any other hint that we have to link our answer to the case study. Then further for part D, okay, I'll highlight the main requirement, ways in which a company can issue new equity shares. Then for part D, I have to discuss and recommend whether LaForge Company should raise the finance it requires by reducing the annual dividend. So they are thinking that the money that we are needing, we will reduce the dividend and then we will get the money that is needed. So primarily these are the 4 requirements that I'm supposed to solve for. Now I will start to read my case study. So it tells me LaForge Company is a listed company. So I've highlighted that we are listed, which designs and manufactures air conditioning units, which are then sold through third-party retailers and distributors. Economic growth in a number of Asian countries has increased the demand for its product, and LaForge Company wishes to target these markets in order to generate sales and profit growth. To target these markets, LaForge Company needs new machinery, which will require an investment of $25.48 million. So this is my investment requirement. Then it's given to me further 2 options for raising the finance are being considered. First of all, the company could go for a rights issue at a 30% discount on the current share price of $2.6, or an issue of 6% loan notes redeemable at a nominal value of $100 in 10 years time. LaForge Company's PE ratio is 11 times, and this is expected to remain unchanged whichever financing option is chosen. Extracts from LaForge Company's most recent financial statements are as follows. Profit from the operations are given, profit for the year after taxes have been given, and the share capital of the company is $0.5 per share. This is the nominal value. So the total value is 35 million. Without the new investment, the forecast profit from operations for the coming year is expected to be the same as the previous year's result. So the forecast profit will be the same if we are not going ahead with the investment. If the investment decision is undertaken, the forecast profit from the operations is expected to increase by $4.5 million. LaForge Company pays taxes at the rate of 20%. So this is all the information that has been given to us, and using this information, we now have to do the workings that we have been told to do. Any doubts in the requirements? Any doubts in the case study? Anything that you people would like to discuss here? No? Shall we get started with the first part? Okay, let's get to part A. So part A, I have to calculate the TERP. So for the rights issue, I will go to my Excel workings. So this is the same sheet that we were using yesterday for part A and the first part. So for the rights issue, I am calculating the theoretical X rights share price per share. So TERP basically has been asked, guys, how do we calculate the TERP? Can you people quickly tell me the formula or what's the approach that we follow to calculate TERP? How do we calculate TERP? Come on, guys, this is very, very easy. How is TERP calculated? Yes, whatever was the value of the company before these rights issue, plus the proceeds that we get from the rights issue, and then we divide it by the total number of shares that are there with the company after the rights issue has actually taken place. So what we are going to do is we are going to use the same formula in this information that has been given to me. So we are going for a rights issue of, at a discount of 30%, at on the current price of $2.6. Do we have the ratio given to us? No, we are not given with the ratio, that in which ratio the shares are going to be issued. So no problem, we can calculate that. Now, right now, if you people see, the company has $35 million of share capital. Can you people tell me how many number of shares we have right now in the company? 35 million is the total value. What is the number of shares that we have right now? 35 divided by 0.5, that is 70. So, number of shares currently. So, we have 35 divided by 0.5, that gives me 70. Now, what is my next step? I also have to see what will be the issue price, at what price I'm going to sell these shares to my shareholders. So it's at a discount of 30% to the current share price of 2.6. So my issue price is 2.6 into 1 minus 30%, or you can simply take 70% also, whatever floats your boat. So 1.82 is the price at which I'm going to issue these shares to my shareholders. Now guys, I need a total of this much amount of money. So if one share I'm selling for these many dollars, how many shares will I need to sell? How many shares do I need to sell if I want to, have these many dollars with me? Yes, I will simply divide. So 25.48 is my requirement. So number of rights shares will be the total amount of money which I need, that is 25.48 divided by the price of one share. That tells me that I need to issue 14 million number of new shares. Do you all follow till here? Any queries in any of the steps that we've done so far? Twinkle, it's mentioned in the question itself that for the new investment that they are doing, they want to have this much amount of money. 25.48 is their total investment. So if the company is going ahead for the rights issue, they will be raising this much amount of money from the rights issue. Anything else, guys? Do you all follow till here? So far, so good, everybody? Okay. Now I know my new number of shares also, my old number of shares also. Using TERP is now very, very easy. So how will I go for it? Firstly, I will take my existing value of the equity. So I have these many number of shares right now, and one share right now in the market is worth $2.6. So this is my current value of equity before going ahead with the rights issue. And then further, when I go ahead with the rights rights issue, my proceeds from the rights issue will be 1.14 into 1.8. Sorry, no, this will be how many dollars are we raising? That is 25.48. 25.48. And then this is my total numerator, guys. Now I have to divide this with the total number of shares. So the total number of shares will be, earlier I used to have 70. Now I have 14 more. So I hit enter. This is what my TERP is now going to look like. This is my final answer for the first part under part A of the requirements. Do you all follow? Shall we head to part 2 now of the same part? Okay. So second part, we are solving for the value of a right per existing share. Can anyone tell me how do we calculate this number? The value of a right per existing share? Firstly, we have to calculate the value of a right per new share. What's the formula that we've learned for that? Value of right per new share I need first. It's the TERP minus the issue price. So I go to my workings. Value of right per new share is actually equal to the TERP minus the issue price. So this is my issue price. That means $0.65 is the value of a right per new share. Now this is not yet my final answer because I have to find out per existing share. So value of right per existing share is actually going to be 0.65 multiplied by the rights issue ratio. So for every 70 million shares, we have issued 14 million shares. So my ratio becomes 14 divided by 70. That means my TERP is actually, my value of right per new share is actually 0.13 per existing share. All clear till here? Second part is also understood? Very easy. Guys, I would appreciate a little bit more participation. If you have any doubts, please feel free to ask the doubts. But if it's clear, please let me know it's clear. Okay. Now we move ahead to the second part of the requirement, wherein what did I have to calculate? I have to assume that the investment goes ahead, and then I have to calculate what the EPS will be, what the share price will be if for the first scenario we are going ahead with the rights issue. So guys, if we are going ahead with the rights issue, to calculate my EPS, to calculate my share price, I will need to know how much is the profit after taxes. Because for EPS, I need to know the profit after tax, and I need to know what is the number of my shares. So right now, if the company goes ahead with the rights issue, let's see first of all what will happen to the profits from my operations. Can you people tell me, will my profits for the operations be the same? If I go ahead with the investment, will my profit from operations be the same? No. Read the highlighted part. Yes, the profits are going to increase by $4.5 million. You people can see these are my workings if you people were asking earlier. Simply multiply it with the rights ratio, Shreya. That's what we have to do. Okay. So the rights issue, firstly, if I talk about my profit from operations. So my profit from operations, whatever I used to have earlier. Earlier, I used to have 25.5. Now it's going to increase by 4.5 million more. So my total profit is now going to come to $30 million. Then the next thing that is going to be subtracted from my profits from the operations is, what will I subtract, guys? From the operational profit, what will I take away? To come to profits after taxes, what do I need to subtract? I need to subtract the interest as well as taxes. Absolutely. So when I have gone ahead with the rights issue, will my interest commitment change from the previous year? No, my interest commitment will be the same because I did not take any more debt. So what was the amount of debt interest that I used to pay earlier? We have to do certain workings over here to find out what was the amount of interest that the company used to pay earlier. So all the information that we need is not readily given. So we have to do certain workings to find that out. So here I will do my workings. So in my workings, firstly, we start off with the PBIT. PBIT or the operations profit is exactly the same. So currently I have 25.5 worth of PBIT. From this, I first take away the interest, then I'm left with the PBT. Then I subtract the taxes at the rate of 20%, and then I come to the profit after taxes. So I'm given with the profit after tax figure, and the profit after tax is 16.56. So 16.56 is the amount of money that I'm left with after paying my taxes. Now guys, if you know that PBT minus 20% of PBT is 16.56, how can I calculate my PBT? How can I calculate my PBT? See, we have this equation that PBT minus taxes. So taxes are basically 20% of PBT. 20% of PBT is equal to PAT. Will you guys agree with me on this equation? Yes. So what can I say? I can say that 80% of PBT is actually equal to PAT. So that means if I want to find out the value of the PBT, PBT will simply be equal to PAT divided by 80%. So here I'm going to enter this number, PAT divided by 80%. So this way I have calculated 20.7% will be my PBT. I can also cross check whether my workings are correct or not. How can I do that? Simply calculate 20% of this figure. So 20% of 20.7 is 4.14, and ideally it should match with the PAT that's given to me in the question. So you can see this exactly comes out to 16.56. Do you all follow? How did we get to 20.7 as the PBT? Yes, very easy. Would you guys agree? It was not directly given, but it was very easy to use the concepts that we have learned as part of the FM paper and calculate the PBT. So now that I have my PBT, I already know that from the PBIT, I would have subtracted the interest to come to the PBT. So same way I can create an equation here also that PBIT minus interest is actually equal to PBT. So if I want to find out the interest will simply be equal to, you can see on the LHS we have the interest. So PBIT minus PBT, and then when you take interest to the RHS, it will become positive. So this is the formula that I can use for the calculation of my interest. So PBIT minus the PBT, this is how much interest I would have paid. Again, I can rectify, I can cross check whether my workings are correct or not, find out the difference between PBIT and interest, and you can see this is exactly equal to the PBT that we had calculated. So you can back check your workings also. This is the current scenario that we have at the moment. Do you all follow? The current scenario workings are understood, everybody? I have tried to break it down for you people as simply as possible. Harkirat, we cannot take 6% of the new amount of borrowing because in the first case, it's told to you that the rights issue is gone ahead with. The company has not taken any new debt. Whatever debt the company has from before, the company will keep on paying interest on that amount. So the amount which the company has taken as debt right now, we don't know that amount. That is why we need to do all of these workings. Okay, I think I saw a similar doubt. Nikita had asked, why are we adding existing profit from operation when we are deciding upon which method of finance should be used? So exactly, Nikita, this is very similar to what Harkirat had also asked. If you read the question very properly once more, if you go back to the requirement, you have to assume that the investment goes ahead. So if the investment goes ahead, it does not matter whether you're going ahead with the rights issue or you're going ahead with loan notes. If the investment is undertaken, your profits from operations are going to increase by 4.5%. I did not say that. The question told me that. That is why we are adding this number. Okay, everyone with me till here? Everybody? Okay, now I know that from the profits from my operations, this is basically my PBIT. I will pay the interest. If the company has gone ahead with a rights issue, will there be any change in the amount of interest that the company will pay now? If the new investment has been funded via rights issue, will there be any change in my interest cost from previously? No, my interest cost will remain unchanged because I did not take any more or less of debt. So if my PBIT is 30, then from the interest, I've taken this from my workings as it is. I have linked the cell also, you people can see, so that my examiner will know where I got this number from. Then I calculate what I call as my PBT. So my PBT is 30 minus 4.8, that is 25.2. Then from this figure, my taxes will be subtracted at the rate of 20%. So equals this number into 20%. This is the amount of money that I will end up paying as the taxes. That means the PAT, profit for the year, will be what I will be left with after the taxes have been deducted. That is 20.16. Now guys, the EPS figure has been asked from me. So to calculate the EPS, what's the formula that we use, guys? What's the formula to calculate EPS, earning per share? PAT divided by number of shares. So guys, if the company is going ahead with the rights issue, how many number of shares will be there with the company? Arhan, we will not just take the new number of shares, we will take old plus the new number of shares. So earlier the company used to have 70 million number of shares. Now the company has also issued 14 million more number of shares. So the total number of shares that are there with the company are 84. Now I have every number that I need to calculate my EPS, PAT divided by my number of shares. So this tells me that if the company goes ahead with this particular arrangement, my EPS is going to be 0.24. Do you all follow till here? Any queries in any of the steps that we've done so far? Okay. Now, for this particular scenario only, we were not just asked to calculate the earnings per share. We also have to calculate the resulting share price. So if my earnings have changed, then my share price will also change. So for the calculation of the share price, the PE ratio has been given to me. So I've learned that if I want to calculate the share price is equals to EPS multiplied by the PE ratio. So PE ratio is given to me in the question itself. PE ratio is given as 11 times. I'll just highlight this. Okay. So 11 times, that means my share price will be 0.24 times 11, that is 2.64. So this is the entire working that we have done for part B, first part. All clear? Should we move to the second part now? Should we head to the second part? Okay, so second part is we will do the workings over here itself because the format remains the same if the company goes ahead with the loan notes. So now with the new investment going ahead, my profits that I used to have previously, the previous profits were 25.5. Now I will have 4.5 million more of profits. So my profits will be 25.5 plus 4.5, that is $30 million. Now, guys, the company went ahead with the loan agreement. So if we are going ahead with the loan notes, then what will happen to my interest cost? Can I take the same amount as it is? Can I take the same amount of 4.8%? No, it's going to increase because now I have taken more debt upon which I will have to pay interest. How much of loan notes would I have issued? How much money did I need for this project? 25.48. So whatever interest I was paying earlier, now my interest obligation will increase. I raised an amount worth 25.48. And on this amount, I will also end up paying 6% interest. So on this figure, 6% is the amount of interest that I will pay. That means my interest on loan notes will now, my total interest as a company as a whole are now going to total to this particular figure. All good till here, guys? Interest calculation is understood by everybody? Okay, now we move forward to the PBT. This is very simple. My profit before taxes are 23.67. Now I go ahead with the calculation of my taxes. It will again be, I can copy paste 20% of my PBT. So then my PAT is going to be this number. This is the amount of money that the company is left with after paying all of the taxes. Guys, please ensure that you're keeping your microphone on mute. And I can see some of you have been trying to make annotations. Guys, this does not suit you. You're all students of professional qualifications. You people are not some school children who need to be schooled about this. So please ensure that this does not happen again. I don't want to see this. It creates a nuisance. It breaks my flow. I don't like this. So this is about the PAT that we have calculated. Now, guys, when the company has gone ahead with the loan notes, what will happen to the number of shares of the company? Will the number of shares change from previously if we did not issue any more equity? Will the number of shares change in the second case? No, it will remain constant, whatever we used to have earlier. So earlier we used to have 70. That means my number of shares is 70. So my EPS will be PAT divided by number of shares. This is what my earning per share looks like. PE ratio, again, we take it from the question itself. It's given to be 11. So I multiply the EPS with my PE ratio to find out what the share price is going to look like. To beautify our workings, we can just round these to 2 decimal places. So this is how we can leave our final workings. Okay, this is the answer for the part 2 of the requirement. Part B, entirely we have solved. We have calculated both the things, the EPS also and the resulting share price as well. Any doubts in any of the steps, please let me know, guys. Ashruti, Adama, Aditi, Arhan, Catalina, Diksha, Dhruti, Throne, all good till here? Okay, great. Now we proceed forward to the part C. Guys, part C is a completely theory-based requirement which does not require any link to the scenario. So we'll just discuss this answer. This is also, all those students who are enrolled with me, you already have the theory document that I have created. So you'll find this answer over there in that document as well. Can you people name me some of the ways that a company can use to issue the new equity shares? What are some of the ways that we have studied to issue new equity? Okay, a placement can be done, private placement can be done, retained earnings, but that's not a new way for going ahead with equity. Rights issue can be done. Okay, what else can a company do? Initial public offering can be done. Bonus issue is the wrong answer over here. So many answers are telling me bonus issue. Scrip dividends, no. Mansi, scrip dividend is a way of giving dividend to the shareholders. It's not a way to get new money out of the shareholders. What happens with bonus issue, guys? Does the company receive any new money with the bonus issue? No. So how can you people say bonus issue as one of the answers here? It's wrong, right? So few options that you can talk about: rights issue, private placement, going for an initial public offering, or going for a further public offering. If the company is already listed, you still want more shares from the public, then you can go for a follow public offer. FPO is what we call it. These are some of the ways that can be done to issue new equity shares to the people. Okay, you explain any 3 to 4 points over here, that will be good enough. Yes, offer for subscription can also be as one of the methods that can be used over here. Okay, now we talk about part D. So at a recent board meeting to discuss the financing options, one of the directors suggested reducing the forthcoming dividend. In the past few years, Laforge company has consistently paid an annual dividend of $0.08 per share. Its shareholders include both financial institutions and individuals also. Now you have to discuss, and then discuss means you have to think from different perspectives. You have to think what will happen to the shareholders, what will happen to the company if we are going ahead with this particular thing. And then further, you also have to give a recommendation. Should they go ahead and do this thing or not? So firstly, we're talking about the discussion part. What do you people think? How much money can the company save if they are reducing the annual dividend? They are consistently paying a dividend of 0.08 per share. That means how much amount of money is being paid to the shareholders as dividends right now? 0.08 is what they are paying at the moment. And they have 70 million number of shares. So how much money will the company be able to raise this way? $5.6 million. Do you guys see, is $5.6 million the number of money, the amount of money that I need? Will that be sufficient for my requirement? No, that's barely 1/5 of my requirement. So if I go ahead with this, one very big drawback is this is not my perfect solution. This is not my final solution because I will still need to go for more sources of finance. What other things are going to happen if the company cuts the dividend? Can we think of some other points? Will the shareholders be happy if every year consistently they have been receiving a fixed amount of dividend? Will they be happy if you suddenly tell them that there's a dividend cut this year? No, they will not be happy. Yes, absolutely, Niyati. We can talk about the signaling effect over here. It is going to signal in the market that the company has reduced the dividend. So the investors will think, they will consider this as a bad news. And when the investors are seeing bad news about the company, what do they do with their shares? Do they keep their shares with themselves or do they start to sell? They start to sell their shares. And whenever the shares are sold in a big quantity, what happens to the share prices? The share prices begin to fall. Absolutely. So signaling effect is going to take action over here. Similarly, I think you people, I see some of you mentioning the clientele effect also. Clientele is basically the kind of people who are investors in Laforge company. So we can see in the requirement, it's told to me that Laforge company has both individuals also, financial institutions also. So different investors, they invest in the market because of fulfilling their different wants, different needs. So Laforge company, they have been consistently paying out these dividends. So for a period of years. So now if they switch to a lower dividend or zero dividend, then it is going to make some of the shareholders unhappy. And if they are owning a large proportion of the company, if they sell their shares, it will again create a real problem for the Laforge company. Then, guys, another thing is that what can we give as the recommendation? What can we give as the recommendation? Should the company go ahead with this? We've discussed a few problems. Should the company go ahead with this? No, why not? What's the reason that we can give? Why do we say that we don't recommend you for this dividend cut? What will happen is this way, first of all, your requirement will not be fully satisfied. Even if you go ahead and do this reduction in the dividend is going to damage the relations with the shareholders. It is going to make them want to sell off their shares. It can lead to even a reduction in the wealth of the shareholders. Hence, we are recommending that this is not something that the company should do. So how will I frame my answer over here is, I will use subheadings. Just see how I frame this answer in front of you. What's the structure that we will follow? Firstly, if you have a look at the requirement, I will talk about the discussion. So in the discussion part, I will talk about my finance needs. Then I will talk about the signaling effect. And then I'll also talk about the clientele effect. And then I will finally write about the recommendation. So what will I say over here is, firstly, when it comes to the finance needs, we say that Laforge company needs $25.48 million for the planned expansion. A cut or reduction in dividends, in future dividends, can possibly help Laforge raise $5.6 million, which means that despite the cut or reduction, other sources of finance will still need to be used by Laforge company. Secondly, I talk about the signal effect. So what do I say over here? I say that the news of Laforge company cutting the dividend after paying a constant dividend over a period of years is going to be perceived as a bad news by the shareholders. Unhappy, they might start selling the shares, which could lead to a fall in the share prices. Further, I could talk about the clientele effect. So I will say over here, different investors invest in companies to fulfill their different requirements. Laforge company has both individuals as well as financial, or you can say institutional investors. Suddenly reducing or cutting the dividend will create a problem for some shareholders who have relied on LaForge for a constant flow of dividends every year. Dividends every year. And then further, I can give my final recommendation. In my final recommendation, what I will write is I will say that given that LaForge Company is a listed company with different shareholders, it is not recommended to go ahead with this decision of reducing the dividends. Neither will this solve their funding problem entirely, nor will it make relations with the shareholders any better. So that is why we are saying that the company should not go ahead with this particular arrangement. Easy, you people can see I have drafted 4 proper points in which I have given at least 2 to 3 sentences of explanation. Yes, I will have to reduce the screen size a little bit. Let me see if you people. Okay, so now you can see the entire answer in one go. So people can see 4 proper points I have formulated with proper 2 to 3 sentences of each of explanation. So now my answer is very, very proper, very structured for a 6 marks of requirement. Any queries that you people have over here? Are we all good? Okay, great guys. So with this, we are done with the first half of our agenda that we have in plan for today. Now, the next thing that we have to do is we will be revising the topic of risk management. Do you people want to go for a small break before we do that, or are we good to continue? Manas, you should be prioritizing the BPP kit first. Let me know, guys. Are we good to continue or do you guys need a break? I see a mix in responses. So, like we did yesterday, let's do the same thing. Let's go for a quick 5-minute break and then we'll resume. Maybe you can fetch yourself some water, tea, coffee, whatever you people want. So, it's right now 8:23 by my clock. So, we resume sharply 5 minutes later at 8:28. All right. So before we continue, I see one question being put by Dhruti in the chat box that she's asking that in the M&M without tax theory, when my KE is constantly increasing and my KD remains constant, how is it that my WACC is still constant? Shouldn't my WACC also increase? If KE is increasing, the the cost of debt remains the same. So why is WACC still constant? Would anyone like to explain this? We have discussed the reason before. How is it that your WACC remains unchanged? This is very important. It tests whether you've understood the concept or not. Anyone who would like to show me that their concept is crystal clear? So Dhruti, if you talk about your M&M without tax theory, what is happening over here? Absolutely correct answer, Shreya. I'm very, very proud of you. Yes, absolutely right, Nikita also. They are both the students from my success batch. Same with Arhan. Arhan also a student of my success batch. Very, very proud of you guys. So what is happening in the M&M theory without taxes is that when it comes to your KE, it is gradually increasing. When it comes to your KD, it remains exactly the same. But in another assumption, we have seen that whatever benefit that I'm getting because of the cheaper debt, that is exactly equal to the extra amount of money that I'm paying because of the increasing cost of my equity. So in one place, I'm saving some money. In one place, I'm having to spend extra money. And both of this is exactly the same. In one place, I'm saving $100. In the other place, I'm spending $100 more than I should have. So in net effect, I'm still standing at zero. My net effect is zero. Wherever I was in the initial position, I'm still having the same amount of cost. I hope it's clear now, Dhruti. Okay, so now we move ahead with our revision for the risk management area of the syllabus. So firstly, guys, when we get started with this unit, this particular chapter from our syllabus, we get to see that there are mainly three kinds of risks when it comes to the foreign exchange. What are the three types? Translation risk, transaction risk, and the economic risk. So in the translation risk, guys, can you people just give me a 2 to 3 keywords that what is the main thing happening with the translation risk? Translation, the name itself is telling you what is translation, converting one language into another. So what can happen is in one company, the different assets can be there in different currencies. So for example, if you talk about any company which is operating internationally, considering a company like Nestle have this headquarters in Switzerland and they operate in different countries around the world. So Nestle over here in India, they will have their assets in Indian rupees, their liabilities in Indian rupees. So even if these numbers, assets and liabilities, they are not changing the entire year, what happens is the numbers that they plot at the beginning of the year, converting them into euros or Swiss francs, will those numbers be exactly the same at the year end? No. Why? Because the exchange rates keep on fluctuating. So this is the translation risk, that the company may face a loss because of converting one currency into another currency. Then we have the transaction risk. So transaction risk simply means a risk that I'm facing on my receivables and payables. So for example, consider that I purchased something from the US. Now we've seen that rupee is now nearly standing at its record low when it comes to the US dollar in compared with the US dollar, Indian rupees that I'm talking about. So if, for example, I entered into an agreement 1 month ago to, buy something from the USA. So I promised to pay them $100 1 month later. Now today, when I'm entering into this agreement, I have, let's suppose, $100 I have to pay. Today, 1 Indian rupee is, let's suppose, if I want to go for one US dollars that I want to buy, maybe I have to pay 90 Indian rupees. So if I want to purchase 100 of US dollars, how many Indian rupees would I need? I need $100. $1 costs me 90 rupees. So how many Indian rupees do I need? 9,000 Indian rupees are needed to make the payment. But now, guys, imagine that 1 month later, when I actually have to make the payment, now that same $1 costs me 95 rupees. So now how much amount of money do I have to pay to get those $100? It will be 9,500 rupees. So you saw, even though my dollar value remained exactly the same, just because there's a difference between when I enter into an agreement versus when I pay for that particular item, my rates can fluctuate. This can cause losses also. Sometimes it can give you profits also. So this risk that the rate will change between entering into the agreement to actually receiving or making the payment, this risk is called as the transaction risk. And then the long-term version of the transaction risk is called as the economic risk. And this risk, guys, can any business, even if you're operating internationally or not, can any business avoid economic risk? No. Economic risk will be faced by every business, no matter whether you are dealing internationally or not. So these are the three different types of risk. Now, a lot of you might have these questions in your mind that why do the exchange rates keep on fluctuating? So today the dollar is, maybe I have to pay 90 rupees today. Tomorrow the rate becomes 91. And then again, every day, every second, it keeps on fluctuating. So why does that happen? We have studied some of the reasons also. Firstly, we have the purchasing power parity theory. According to this theory, what's the one thing which influences the changes in the exchange rates? What is that one factor which causes the changes to happen according to the purchasing power parity theory? Yes, it's the cost of living or the inflation. Absolutely right. And according to the interest rate parity theory, which factor causes the changes in the interest rates? The exchange rates? It's the interest rates, absolutely. And then you have the Fisher effect. We've learned the Fisher formula. 1 plus nominal rate will be equal to 1 plus real rate into 1 plus the inflation that is happening in the economy. Then we have the expectations theory, that whatever we are expecting the rate to be in the future, that will be something which will actually come out to be true in the future also. In very simple words, today, right now, let's suppose dollar is standing at 95 rupees. Now, I am having an expectation that a few months from now, let's suppose just 3 months later from today, the rate is going to be 100 rupees for $1. This is my expectation. So what does the expectation theory says? Whatever you're expecting, that will happen to be true. So when you actually go 3 months into the future, this is what is going to happen. $1 is going to cost you 100 rupees. This is the expectations theory. Then guys, all the 4 theories that we have studied, the purchasing power, the interest rate parity, the Fisher effect, and the expectations theory, they all use some of the other common components. So that is what we call as the 4-way equivalence. You people would have seen the flowchart on the study hub. If you've studied from over there, then definitely you would have seen that. All of my success batch students have been taught that. And if you still haven't, then ensure that you go to the study hub and you check that diagram out, wherein they have shown you the link between all the 4 theories that we have just now spoken about. And then you have the BOP effect also. BOP is the balance of payments. In very simple words, it's simply the transactions that the citizens of a country are making with the rest of the world. So Indians, how they are buying things from outside, how they are selling things to outside of India. We have 2 main components of the BOP account. Can you people name me those 2 components? What are the 2 components of the BOP account? Current account and the capital account. What does capital account include? What does the capital account include? Foreign investments, loans, transactions done by the central banks of the economies. And then what does the current account include? Current account includes the exports and the imports. So this also creates an impact on the exchange rates that keep on fluctuating. So far, everybody is with me? All good till here, guys? Okay, now we move forward to some of the hedging techniques that we have studied as part of this particular chapter. So we have learned 2 different categories of the techniques. First is your internal techniques. Then we have studied about the external techniques. So within internal techniques, we've studied about invoicing in the domestic currency. So for example, I want to purchase something from the USA. So how can I avoid my risk? My risk is that dollar may keep on getting more expensive. So what do I say? On the day when I'm entering into the transaction, I tell my US supplier, hey, will it be okay if I pay you 9,000 Indian rupees? So my headache is now fixed. I only have to pay 9,000 rupees. Now it's the headache of my supplier that when he converts those rupees into dollars, how many rupees he's going to get. What is hedging, Twinkle? The risk that the company is facing. So going for security measures for the risk, doing something to reduce the risk, that is what we call as hedging. Okay, so invoicing in domestic currency, we've studied the concepts of leading and lagging. What happens in leading? Payment is done early or late? Earlier than needed or later? Early payments are done in leading. What happens in lagging? We delay the payments, absolutely. Then we have also learned the concepts of matching of receipts and payments, matching of the assets and liabilities, and then ultimately going for the ALM, asset liability management. This is also called as a balance sheet hedge. Then guys, this is the main part which is also going to be tested as part of your numericals. So a forward contract is wherein I am getting into an agreement today that this date in the future, we are going to exchange this much of currency at this particular rate. No matter whatever is the rate that is prevailing in the market, we will exchange our payments on this particular rate. So everything is decided today. But does the transaction take place today? Does the transaction take place today? No, the transaction takes place some date in the future. Then we have also learned the concept of a money market hedge to do the external hedging. In the receipt scenario, what is the abbreviation that we follow? In the receipt scenario, what is the abbreviation? It's BCD, borrow, convert, and deposit. Always and always, guys, first of all, the very first step that we are doing, borrowing, will it be in foreign currency or will it be in local currency? It will be in the foreign currency, absolutely. And the last step that we will do will be in the local currency. Then if you talk about the reverse scenario, rather than a receipt, if you have to make a payment, then what is the abbreviation that we follow? It's DCB, absolutely right. Here also the very first step, that is deposit, will be done in the foreign currency. This is how money market hedges work numerically. Currency options, currency swaps, they will not be tested for you people in numericals. Futures, forwards, and money market hedges can be asked when it comes to the numericals. Now, the concept of a forward is nearly the same as a future. But can you people let me know the key difference that we have between forward and future contracts? Success Batch students, I've told you also the technique to remember. One letter that you see in forwards, because of which you can very easily distinguish which one is which. Forward contracts are OTC, they are over the counter, they are custom made arrangements. So does that mean, what does it mean? Can I trade a forward contract on the market? Something which is customized for you, you cannot sell it to somebody else. But when it comes to futures, they are exchange traded. That means if I want to sell it off before its expiry, can I do that? Yes, of course I can. They are guaranteed by the exchanges and there's no risk of default. But when it comes to forwards, because they are OTCs, there are also chances of default that are possible. So the counterparty, for example, I entered into a contract with maybe Niyati. So on the day of the contract, the settlement day, what happened is I have made a huge amount of profit and Niyati made a huge amount of loss. This was a forward contract, so there was no intermediary in middle. What happened is after seeing such a big loss, Niyati decided to run away. So can I do anything over here? No, I have to face the risk of bad debts. But when it comes to futures, is there any risk of the credit or the counterparty risk? In futures, do we face any counterparty risk? No. Who is guaranteeing you to receive the payments on time? Who gives that guarantee? The exchange, the foreign currency market, not the stock market, Shreya. Stock market, we do not trade currencies. Currencies are traded on the currency market. So the currency markets give you that security that no matter what happens, your money will always reach you on time. You do not face any risk of default. So these are some of the internal as well as external techniques that we have studied in context of the foreign exchange risk. Do you all follow till here? Okay. Now we proceed ahead to the second leg of this chapter. So the risk management chapter, it basically is divided into two legs. First leg is about the foreign exchange risk which a company can face. And then we have studied about the interest rate risk also. So whenever a company is borrowing money, whenever a company has to deposit money in the future, whatever is the interest rate which prevails in the market, that is going to really affect the company. So for example, consider a scenario, guys, wherein in the future you were thinking to borrow money. So if you were thinking to borrow money, what is going to happen? What will you be afraid of? If you have to borrow money in the near future, what will you be afraid of? In the context of interest rates, what will be a problem? If interest rates go up, that will be a problem, or interest rates going down will be a problem. Interest rates going up will be the concern that you will have. So here you would want to fix the maximum amount of interest that you would have to pay. But on the vice versa side, if you are thinking to make a deposit in the near future, then what is going to be your fear about the interest rates? That your interest rates will fall down. Absolutely. So to manage this risk, we have the techniques of the interest rate hedging. Yes, Shreya, you're absolutely right. OTCs are non-tradable. They cannot be traded with somebody else on the market. It's a custom-made arrangement for you, so you cannot go in the market and trade it. Now, interest rate risk is because of the fluctuations that keep on happening in the interest rates. It could be if I want to borrow money, if I want to invest money, and we have also learned the concepts of gap exposure as well as the basis risk over here. Guys, what do we mean by gap exposure? What is meant by gap exposure? These concepts should be on your tips because it can be tested in the MCQs. Yes, absolutely. Thank you, Shreya. It's the difference between my interest sensitive assets and my interest sensitive liabilities. So if, for example, I have assets with me which are bearing interest, they are, whatever the interest rates keep on fluctuating, return from those assets will keep on fluctuating. Let's suppose the assets are worth $10 million and the liabilities are worth $4 million. So we have a difference over here between these values. This difference is called as the gap exposure. And depending upon whether assets are more than the liabilities or liabilities are more than the assets, we give them different names. So what is the type of name that we give to the gap exposure where the assets are more than the liabilities? It's a positive gap exposure. And when the liabilities are more than the assets, then what's the name that I give it? Negative gap exposure. Absolutely right, guys. Then we have also studied the concept of the basis risk. So we have studied that the variable rates that are decided around the world, they are decided using different rates. So we have the SOFR, which is the secured overnight financing rate. We have the SONIA, which is the sterling overnight index average rate. So these two different rates, what happens over here is that basis risk tells you that maybe some of my assets are dependent upon SOFR, but my liabilities are dependent upon SONIA. So there's a risk that my variable interest rates may be decided on different bases. It could be SOFR for one, SONIA for another. So that risk is called as the basis risk. Right? Then for the hedging of the interest rate risk also, guys, we have studied a few techniques depending upon whether we do it internally or we do it externally. Yes, basis risk also is used for one more terminology. Basis risk has two connotations when it comes to this particular chapter. Firstly, basis risk is about your, what we were discussing being measured on different bases. And then another meaning that we have with the basis risk. What's the other meaning, guys? What's the other meaning of basis risk? This is in context of futures, giving you people a hint. In the context of futures, we have studied that the prices of the futures and what you see at the spot, are those prices always matching? The prices that you see in the future versus the price right now, those prices do not match each other. So there's a little bit of extra that we pay usually in the futures. So the difference that we have between the future rate and the spot rate that is available today in the market, that difference is called as the basis. And we have a risk that basis has to go to zero. That is for sure. We know that on the date of expiry, the spot will be actually equal to the future because now future has arrived. So both of the things are now standing at present. So they have to be equal. Now what happens is there's an assumption that the basis will come to zero. Both of the numbers will get equal at a constant rate. But that is not necessary. So that risk that your basis will not fall to zero at a constant rate, that risk is also called as the basis risk. So you have to see that if you get a question about basis risk, you have to read the question to understand the context. Are they talking about in the perspective of different bases being used for different assets and liabilities, or are they talking about the basis risk in the context of the futures contracts? Right? There are two connotations of basis risk. Now, guys, talking about the two sorts of techniques that we have learned for the interest rate risk hedging, we have learned internal as well as external techniques. Internal techniques are just conceptual in nature, no numericals from the internal techniques. We have the concept of smoothing. What exactly happens in smoothing? Can anyone explain it in easy language, easy words? What happens in smoothing? Yes, we create a balance between the fixed and the floating rates. So you people know that in an economy, you have the choice to borrow money. For example, if you want to borrow money, the bank will give you a choice. Do you want to borrow at a fixed rate or do you want to borrow at a variable rate? Now, the thing is, with a fixed rate, it does not matter whatever happens to the rates in the market, your rate will remain the same. But with the variable rates, whatever fluctuations happen in the market, if the market interest rates go up, you end up paying more interest. If the market interest rates fall down, you have to pay lesser interest. So there you can get the benefit in case the interest rates go down in the market. So what does smoothing tell you is, smoothing says rather than going for only all in the borrowing that you're doing as fixed, rather than doing it completely fixed or completely variable, let's try to create a balance. Let's take some amount of debt at fixed rate and some amount of debt at a floating rate. So that way is what will happen is, even if the interest rates keep on increasing, I will only have to pay a higher interest rate on my floating component. And if the interest rates fall down, then I will have to pay lesser interest on my floating component. So it will be a win-win situation under both conditions. Some way or the other, I will be able to take the benefit. Then we have learned about the matching concept also. What do we do in matching? Like the name itself is telling you. What do we mean by matching? So a company will have assets also which give you interest. You will have liabilities also on which you have to pay interest. So what happens in matching is, we are saying that if I have an asset which is based on a variable rate, let me also have a liability which is based on a variable rate. So for example, if interest rates go up, I will have to pay higher interest on my loan, but on my deposit also I will be getting a higher interest. And in case the interest rates fall down, I will benefit because I have to pay lesser money on my borrowings, but I will also receive lesser money from my the assets that I have deposited. So this is matching, that I create assets also which are linked on variable rates and liabilities also which are linked on variable rates. This is the concept of matching. Now, a lot of students think that matching and asset liability management are exactly the same thing. How many of you think so? Matching and ALM, are they the same? Are matching and ALM the same things? They are very similar, but are they completely the same? That is the question. Twinkle is not sure. What about the others? Where are my success batch students? Arhan, Shriya, are they the same? What's the difference? Yes, the difference is coming towards the maturity. So, with matching and asset and liability management, we are trying to link the assets and liabilities to the variable rates. And then here with ALM, we are also trying to match their maturity. So with asset and liability management, what I will try is if my asset is for 6 months, I have deposited, I've created an FD for 6 months, then the loan also that I will be taking will be for a period of 6 months. So this is the main difference. We are doing the same thing. Matching is the same, but when I am matching the maturity also, then it is called as the asset and liability management. So these are the internal techniques how a company can manage their interest rate risk. Then we have learned the external techniques also. We have the concepts of FRA, forward rate agreement. So under a forward rate agreement, what do we have to do is we have to consider that if, for example, I want to deposit in the future, I go to the bank today and I tell them, hey, listen, I will come to you after 6 months and I will deposit my money with you for a period of, let's suppose, 3 months. So what is the interest rate that you can offer to me? And then we lock that interest rate today. Then it will not matter what will be the interest rate after 6 months. Whatever the bank has agreed to give me today, they will continue to honor that agreement. And how do we write the terminology of the forward rate agreement? If, for example, the agreement will start 6 months later and it will be a 3 months of deposit, how will I write this FRA? Yes, it will be 629 or 6v9. Both of them are correct presentations. So first is the number. That number represents after how much time the agreement will begin. So agreement will begin after 6 months. And then the next number, the second number is the number of months for the total agreement. So it starts 6 months later and then the deposit will be for a further 3 months. So from today till the end of the agreement, we have 6 plus 3, that is 9 months. So 6v9 or 629 is the way that we are going to write about this contract, about this agreement. And then guys, we have the interest rate futures. Again, futures and forwards, they are nearly the same, but the same difference that we had learned in the currency hedging also. The forward rate agreement, the forwards, they are OTC, they are over the counter, they cannot be traded in the market, they have a risk of default. But interest rate futures, they are traded on the exchanges, and because of that, we do not have any default risk, any counterparty risk in the futures. And then for the options, for the swaps, these are only for your perspectives to understand about how conceptually they work. No numericals will be tested from the options and the swaps. All good till here, guys? Any queries, please let me know. Nikita has asked, for chapter 17, theory needs to be understood conceptually more rather than learning for section C. Yes, Nikita, usually the unit that we are revising right now, risk management, it usually gets tested as part of section B of your paper. So your focus should be to get your concepts as strong as possible and practice more and more of the section B type of questions. Section C, I have not, in my entire career, I've never seen a section C question coming from the risk management area. Mostly it comes up in the section B of your paper. But conceptually, I would add one thing. If you're conceptually clear on all of the concepts, you will be able to tackle the questions irrespective of whichever section they come up in your paper. Dhruti, yes, numericals can be tested on the futures. How do we find out the price of the interest rate futures? Thank you for asking that. I remembered we can recollect this concept also. How are the prices of interest rate yes, absolutely. Thank you, Shreya. 100 minus the rate of interest. So if the rate of interest is 10%, then the price of the future will be 100 minus 10, that is $90. So this is how the interest rate futures are priced. Okay. Are we ready to go for question practice now? Not before, we just have a quick look at the tips that I had given to you people earlier. So firstly, in section B, we will read the scenario very, very carefully, highlighting any information that we think could be of use later. We have to be very careful about the rounding of instructions because this is completely marked by a computer. And then guys, time management, the last but not the least, is very, very important. A section B case study will carry 10 marks in total. So 10 times 1.8 will give you 18 minutes for one case study. So these are the things that I want you people to keep in mind while you are solving a section B kind of a question. So now we are ready to go for a question practice. This again, as you people can see on your screen, this is also a past paper question which I have picked up from one of the examiner reports. So we will now solve this particular question together. So let's read the case study first. Marigold Company is based in a country which uses the dollar as its home currency. Marigold Company has a wholly owned subsidiary based in a country which uses the M shilling as the currency. So we have a subsidiary. We own this subsidiary completely. 100% I am the owner of the subsidiary, and the currency which they use over there is M shilling. The subsidiaries' financial statements are also prepared in M shilling. So guys, even before reading anything further, can you think of one risk which Marigold Company will for sure be facing? Yes, it will be the translation risk. Absolutely, guys. Due to economic uncertainty in both countries, an exchange loss of $100,000 is expected to occur after consolidating the results of subsidiary into the group account. So you people can see this is exactly the language that we had studied about a translation risk. Further, Marigold Company is expecting a receipt of $300,000 from a subsidiary in 3 months. So this is a receipt of these many dollars in 3 months, which it wishes to protect against exchange rate movement. The following information is available. So we are given with the spot rate, we are given with the 3-month forward rate, and we are given with the rates for performing a money market hedge also. So this is all the information that has been provided to me. Now, my first question is asking me which kind of exchange rate risk would Marigold Company experience with this $100,000 of loss in its consolidated financial statements? So give me answers very, very quickly. We have just discussed this. Which risk does this represent? Yes, option B is my final answer. Very easy question. Are we good to move ahead to question number 2 now? Okay. So question number 2. If Marigold Company uses the forward market hedge, so we are going to use the forward market hedge to hedge the MS receipt, then what amount will be received to the nearest dollar? So I have to give my answer in nearest dollar, that how much amount of money will be received. So this is all the information. Take 2 minutes, solve and let me know your answers. Then we will discuss this together. Okay, I'm already starting to see your responses. Forward rate, it's very, very easy. You simply have to find out that how many dollars. There are two major things that you need to consider. Firstly, do we have to divide or multiply? And secondly, do we have to take the higher rate or the lower rate? So let's figure out first of all, will we have to divide or multiply? So to find that out, I have to see which currency is strong and which currency is weak. If you have a look at the exchange rates, even have a look at the spot rate for that matter, for every dollar you are receiving more than $1, more than one of the M shilling. So who do you think is stronger? Dollar is strong or M shilling is strong? Dollar is strong. So now guys, when this particular subsidiary, they are going to pay me $300,000. They are going to pay me 300,000 of the weak currency. So when I convert weak currency into strong currency, will I get more dollars or will I get lesser dollars? I will get lesser dollars. So doing what? No, Mansi, revisit. You are receiving a stronger, you're receiving a weaker currency and you're converting that into a stronger currency. Imagine the weaker currency to be rupee and the stronger currency to be dollars. So if you have more rupees in your hand, will you get more dollars or less dollars? You will get lesser amount of lesser amount of dollars. So what happens is now I know that whatever I do, my value should be lesser than 300,000 in value. So what should I do? Should I divide or should I multiply according to the rates that are given? Division will give me a lesser value. Now we know that division has to be done. The second question now has to be answered whether I take the first rate or I take the second rate. How are the rates decided? I have told you people, the dealer will always take the advantage. Will the dealer want to give you more dollars or lesser dollars? Dealer would want to give you lesser number of dollars. Using which rate will you receive lesser number of dollars? Yes, at the higher rate of 1.1125, because the higher your denominator, the lesser will be the final answer. So your final answer that you will get will be 300,000 M shilling that you will receive divided by 1.1125. And like you people are telling me, how much does this lead to? If I solve this on my calculator, 300,000 divided by 1.1125 gives me 269,662.92. Now guys, my rounding of instructions were extremely very clear. I have to give my answer to the nearest dollar. What I am seeing on my calculator is 269,662.92. 662.92. So what should I enter as my final answer, guys? Yes, I should round it to 269,663. This is the figure that I should be entering in my final answer, 663. So this is the number that I will enter as my answer for question number 2. Are you all with me till here? Shall we proceed to question number 3? Okay. So heading towards the third question now. Match the appropriate value to the relevant target in order to reflect what amount Marigold company will borrow and deposit if they are going ahead with the money market hedge to hedge the M shilling receipt. So guys, we know that this is a receipt scenario. Under a receipt scenario, what is the acronym that we follow? Under the receipt scenario, what is my acronym? It is BCD, borrow, convert and deposit. So my first step will be to borrow which currency? Borrow my foreign currency. What is foreign currency for Marigold company? MS. The M shilling is the foreign currency. No, Arhan, please read the question very carefully. I have highlighted the things also. I do not understand how you people can make so many of these mistakes, which is clearly given to you in the question. Dollar is the home currency. It's as simple as that. I had highlighted this also. So when it comes to the foreign currency, the M shilling is the foreign currency. So I need to find out how much amount of M shilling needs to be borrowed. Do I need to borrow the complete amount of 300,000 M shilling? Do I need to borrow the full amount? No, I need to find out how much money should be borrowed today so that after 3 months it becomes exactly equal to 300,000 M shillings. So today I will need to borrow lesser so that when interest gets added in total it comes out to 300,000 MS. So what I do is I have to divide it by 1 plus the rate of interest. And which rate of interest? The rate of interest which is available for the M shilling in borrowing. So you can see annually 4% is the rate that is given for M shilling under the borrowing scenario. So that means which rate am I going to use for the borrowing? Should I take in the denominator 1 plus 4% or do I need to make any adjustments? Yes, I have to convert it for a period of 3 months. So 4% is for the whole year. And if I want to convert it for 3 months, I have to multiply it with 3 by 12. So 4 times 3 by 12 will give me 1%. So what I will do is I will take 300,000 and I will divide it by 1.0. 1. So when I do this on my calculator, 300,000 divided by 1.01 gives me 297,029.7. So let's see which answer is the closest. So 297,030. This is the closest. This is the amount which will be borrowed. This is the first step that we have done. All good till here, guys? Step number 1 is clear. Step number 1 is understood, everybody? What's the second step? Revisit your acronym. It was BCD. What does C stand for? C stands for convert to the home currency. So now you have 297,030 shillings with you. You want to convert this into dollars. So conversion happens today. So today's rate are also given to you. These are the rates that will be used for today. So how many of the shillings do you have? 297,030. So when you convert these shillings into dollars, can you tell me how many dollars we will get? Yes, we will convert this to the dollars, and when you are converting it to the dollars, you will simply divide it by the higher rate. So the higher rate that is given to us is 1.1250. 1.1250, which gives you 264,026. So let's see which option is the closest over here. 264,046 is what we were getting. Sorry, 026. So this is the closest. This is the amount that will be placed on the deposit. Understood, guys? This is the second step of our calculations. Even though the third step has not been asked, the third step is when I'm putting it on a deposit, I want to find out how many dollars will be there with me after 3 months are over. Can you guys help me with the third and the last step also? What will be my last step? I will see how much amount of interest is being received on a US dollar deposit. So you can see for the whole year, 6% interest is paid on the deposits in the dollar currency. So for a period of 3 months, I will be getting into 3 by 12. So 6% into 3 by 12 is going to give you 1.5%. So what you will do is you will take this number 264027 and you will multiply this with 1 plus 1.5%. So when you do that working, your final answer 264027 into 1.015, this will lead you to 267987, 267987. This is the final answer. This is the final amount of dollars which the company will get after the deposit period comes to an end. So this is the third step. Even though this was not asked from us in the requirement, I have shown you people all three steps that are there in a money market hedge. Question number 3, any queries in any steps? Please let me know, guys. Shreya, because it's asking you the amount you need to deposit. So the amount we need to deposit, we have calculated how much we need to borrow, and that borrowing, when it is converted, that is the money that I'm depositing in the first place. If the third step was asked, how would the question have been different? The question would say amount to be received after deposit is over, something like that. Any doubts still here, guys? Do you all follow? Please tell me yes or no so that I can proceed accordingly. Okay. Now let's move to the second last question for today. Marigold Company is now considering the use of an option to hedge the currency risk on the MS receipt. The bank has offered an over-the-counter option. Over-the-counter means it will be customized for me to meet my requirements with an exercise price of 1.1250 per dollar. I have to select two statements which are actually true. So I give you people 2 minutes, read through the statements very, very carefully, think and let me know your answers in the chat box, and then we will discuss this together. Okay, I am receiving your responses. Most of you are saying that it will be option A and C. And those of you who are saying that, you people are absolutely right. Let's discuss these statements one by one to understand why A and C are correct and why B and D are incorrect. So option A tells you the option will be more expensive to set up as compared with the forward contract or the money market hedge. So if you talk about the money market hedge, the forward contracts, options are definitely more expensive. Can you people tell me why are options more expensive? Options give you the choice. In a forward contract, in a money market hedge, you people are locked in. Whether it gives you a benefit or it is making you a loss, you still have to honor the agreement. But is it necessary with the options contracts? Is it necessary for you to exercise the option? You have no choice? No, it does not work that way. Option itself means that you will be given a choice. So statement A is absolutely correct. Whenever you're getting a choice, it is going to be more expensive for you. Option B says imperfect hedge will happen because only a standard amount of currency and whole number of contracts can be used. But what happens in a customized arrangement? Customized arrangements are tailor made for me. So, are there chances of imperfect hedge happening? If something is tailor made for you, it will fit you perfectly. It will neither be too loose nor will it be too tight. So it will fit you perfectly. There has to be a perfect hedge with a customized option. So B is incorrect. Option C says if the dollar was to strengthen against the M shilling, Marigold Company would be worse off by using the option compared to either a forward contract or a money market hedge. Before we discuss the explanation for this one, we can very easily eliminate option D. How? Option D says that using options, Marigold Company will be obligated to exercise the options irrespective of the spot rate. Guys, does the buyer of the option have the obligation to exercise the contract? Is it how options work? No, options give you a choice. If you want, you will exercise. If you don't want, you can let the option lapse. So D has to be eliminated. That means option C definitely has to be my other correct statement. But why is option C the correct statement? Firstly, understand what the statement means. So if dollar strengthens against MS, so what will happen if the dollar is getting stronger? If the dollar gets stronger, now your receipt is coming in the M shilling. So the M shilling, if the dollar is getting stronger, that means the M shilling is getting weaker. So what will happen over here is whatever is the spot rate will be even badder compared to the exercise price, because if dollar gets stronger, when you convert those M shilling into the strong dollar, you will end up receiving lesser amount of M shilling. So if that happens, you will have to go ahead with the exercise price. That means you have to pay the premium and you also end up losing money because your dollar became stronger. So converting those M shilling, you were able to receive lesser amount of dollars. If the other instruments were used, what were the other instruments? My forward contract or a money market hedge, then I could have gotten better rates than the exercise price of my option. So that is why the C statement is absolutely correct. Do you all follow till here? Shall we move to the last question for today? Yes, Shreya, the company has already locked in the rate, but we are not just comparing for the options, we are comparing it with a forward contract as well as a money market hedge. So the overall cost will go quite up because in a forward contract, I don't have to pay any premium. In a money market hedge, I don't have to pay any premium. Options will come more expensive. First of all, I will lose out money because the dollar got stronger. Secondly, I would have paid premium also for that. So both ways I'm spending extra money or receiving lesser money. That is why options become more expensive. Okay. Now moving forward to the last question for today. If Marigold Company is unsure whether to use a forward contract or a money market hedge, and is comparing the relative advantages and disadvantages of the two, you have to tell which of the following statements is true. So one statement needs to be selected, which you feel is true. Have a careful look at all four of the statements. Think and let me know your answers. Then we will discuss this together. Okay, many of you are coming up with your answers, and you people are saying that it will be option B. Those of you who are saying option B will be the answer, you people are absolutely right. Now let's break down the statements one by one. If you have a look at statement A, it says that the forward contract has an advantage of being tailored precisely to Marigold Company's requirements. Do you people agree with the first statement till here? Is statement A correct till here? Forward contract can be tailored precisely to Marigold Company's requirements? Yes, we agree. So why is this not the answer? Maybe because of the second part. The second part of the statement says a money market hedge will be a standardized instrument resulting in an imperfect hedge. Is this always necessary that this will be an imperfect hedge? A money market hedge, will it always be imperfect? No, money market hedge, we have the choice. We can go for a custom arrangement also, or we can go on the markets as well. So statement A is not entirely correct. That is why this cannot be my answer. Statement B tells me the forward contract will result in Marigold Company receiving the dollar equivalent of the MS receipt in 3 months' time, whereas the money market hedge will provide Marigold Company with dollar receipts today. That is exactly what is going to happen with forward. We enter into the agreement today, but the actual money I will receive 3 months later. But when I'm going for a money market hedge, you remember the steps that we were doing? BCD. We borrowed the M shilling today. We converted those M shilling into deposits, into dollars for the deposit. So dollars I have received today itself. So statement B is absolutely true. Now let's also see why statement C and D are incorrect. Statement C tells you that the forward contract will result in the effective rate of exchange rate being fixed, whereas money market hedge will allow Marigold Company to make to benefit from the favorable movement in the exchange rate. So guys, what do you think? First half of the statement, you agree? Forward contract, we will be able to fix the rate today. You agree with the first half of the statement C? Yes, we do. But what is problematic? The second half of the statement is problematic. Can Marigold Company benefit if it goes in the favor, if they are going ahead with the money market hedge? No. Where is it possible to benefit from the favorable movement in exchange rates? Under which sort of contracts? Under options. Absolutely right. So C statement is also incorrect. Now talking about D, Marigold Company will be obligated to fulfill the contract in 3 months' time, whereas money market hedge can be traded on the exchange before the settlement. What do you people think? Can money market hedges be traded? No. So the second half of the statement is again something that I am disagreeing with. So D statement is also wrong. That means my final answer has to be option B. So guys, with this, we come to our end of the agenda that we had for the day 2 of the webinar series. Tomorrow, I will meet with the enrolled students for the revision, for the grand revision as part of the day 3. The enrolled students who are there at Being SSA, they will get the exclusive access to it. You can still be a part of it if you join the revision batch for June 26. Here you will get the revision of the entire syllabus in very crisp summary form. You will also get to have 6 of unit-wise tests, 2 of the mock evaluations, live sessions for the practice, and the past paper question recordings, along with the doubt support. If you want to enroll, there's also a 10% off that you can get with this coupon code Being ACCA 10. In case you people want to remain connected with me after the webinar also, this over here is my WhatsApp number. You can save this, or you can directly scan this QR code to directly message me on WhatsApp. So this is the end of the day 2. It was a pleasure to have you people over here. We have revised 2 of the key areas of the syllabus. And those of you who I am meeting for the last time, I wish you all the very best for your June attempt. I hope that you people clear the exam with really good marks. And I hope that these webinars were really helpful for you people. I will be sharing all of the resources that I've used in the webinars maybe tomorrow. Is Islamic finance important from perspective of Section C? Absolutely, yes, Shreya. Very commonly repeated topic. You're most welcome, Twinkle. You're most welcome, Yulia. All right. Okay, guys. I'll see you people the next time. All the best. Take very good care of yourself. Bye bye.